Okay, so this is chapter number 5, and I'm going to be working a problem calculating variable costing and absorption costing for products and then reconciling the two. So in this problem, and I believe it's 521 in your book, you're given information for a product. You're given direct materials, direct labor, variable overhead, variable selling, fixed manufacturing overhead, fixed selling, and you're given the sales price of $60 per unit. You're given production and sales data for July and August. You're given an income statement for July and August, and you're asked to determine the unit product cost under absorption costing and under variable costing. So absorption costing is what we've done up to this point. It's your direct materials, direct labor, your variable overhead, and your fixed overhead. We really haven't even talked about those separately too much. And so my absorption fixed costing is going to be my $7, which is my direct materials, which is given to me, my $10, which is also given to me, my variable manufacturing overhead, which is given to me, and my fixed manufacturing overhead. Now that number is not given to me. So I'm actually going to go over here. If this is not accurate, let me go ahead and delete that. I'm going to go over here and show you how you get your fixed manufacturing overhead. And so we know that our fixed manufacturing overhead is $315,000. And we know, let me get in the right month. Okay, so we produced 17,500 units. Now it's overhead, it's a manufacturing overhead, so you're looking at units produced, not units sold. Because you're trying to get the cost per unit. Okay, so that is my fixed overhead per unit. So now I can go back to this original formula, 7 plus 10 plus 5 plus 18, and that gives me my absorption cost per unit. Now my variable, it's the same idea. It's my direct materials, my direct labor, and my variable overhead, but it does not include fixed overhead because it's variable costing. So it would be my 7 plus my 10 plus my 5, and that's it. So that's our cost per unit under each of the different methods. Variable costing is managerial in nature, meaning that it's not what you base your generally accepted accounting principles, your external financial statements. You don't base it on that, but it's a better analysis to look internally at management reports because you're looking at changes in your net income as your volume increases or decreases. And remember, when that happens, fixed costs don't change. So it's a really good tool for us. And when we use this tool, we often use contribution format statements. So the next thing it asks us to do in this problem is to do a contribution margin format statement for both July and August. And so just to put it in good form, this is Denton Company. Now remember, these are internal, but you still need to label them appropriately because you're preparing them, but you don't know where they're going to go throughout the company. So you want to make sure that they're labeled appropriately. It's a variable costing income statement. And we are doing this for July and for August. And with any income statement, we start with sales, and with a contribution margin, the next thing we're going to do is subtract our variable expenses. And we're going to subtract all of them. So first of all, our variable cost of goods sold. And then we're going to subtract our variable selling and administrative. And then that will give us our total variable expenses, and when we subtract that from sales, we'll have our contribution margin. So I'm going to go ahead and just start with this. Move that over for some formatting. And our sales is given to us, so it's $900,000 for July. And for August, it's $1.2 million. Our variable cost of goods sold, let me go back to the problem. Our variable cost of goods sold, it tells us that we sold 15,000 units in July, and we know that our variable cost, product cost up here is $22. So if we take our 15,000 units sold times our $22, then we have our variable cost of goods sold. And I'm not going to put any decimals in this. Then I have my variable selling and administrative, and I know that is $3 per unit. And I sold 15,000 units, and so that is going to be my 15,000 units times my $3 per unit, or $45,000. And so I have a total variable of $375,000, which gives me a contribution margin of $525,000. So that's for July. Then for August, same idea, except in August we sold 20,000. So multiply that by our cost of goods sold. And then we sold 20,000, and we multiply that times our variable selling and administrative, which is $3. And then again, I can carry these formulas over. I have my total variable expenses, and sales minus variable is my contribution margin. And I've just got my formatting all messed up, so let's just switch over to, there we go, that's much better. Okay, and then after my contribution margin, I'm going to have my fixed expenses listed. Now, what's different, hopefully you've picked up on what we've done different from a traditional income statement. Normally we do sales minus cost of goods sold gives us gross margin. This is contribution margin. That's different. Gross margin is sales minus the product cost using absorption costing. So remember that as you work through these. So my first fixed expense that I'm going to subtract here is fixed manufacturing overhead. And then I have my fixed selling and administrative. And those are given to me. Those are fixed. They don't change based on volume. So 315 and 245. And so if I add those together, I get my total fixed expenses. And then if I subtract that from my contribution margin, I get my net operating income. So my total fixed expenses, I can sum those together. My net operating income is my contribution margin minus my fixed expenses, or a loss of $35,000. So for July, my fixed expenses did not change. Remember, within a relevant range, they do not change. Should be able to carry these over. There we go. And I find out in August, I had a net operating income of $140,000. And again, you know, the whole point in doing this is to analyze what's going on. We can't change our fixed. So in July, we had a loss. Obviously, it was a result of lower sales. And so again, it's just a tool we use in analyzing what's going on with our company. Then one other thing you do when you use variable costing income statements, you want to reconcile that to your absorption costing or your traditional income statement. And if you'll notice, the only thing different really is that we've taken our variable period expenses and put them up here, and we've taken our fixed product expenses and put them down here. Bottom line is still the same. So if we want to reconcile this, what we do is we take our variable costing, net income or loss, and we add or deduct. Now this is what I really want you to see, our fixed manufacturing overhead deferred in inventory under absorption. Okay, so think about what we just said there, and you might have to do this a couple of times before it really clicks. Okay, so what's happened is this fixed manufacturing overhead. In variable costing, we expense it all. Because it's fixed, it comes down here. In product costing, because that number, fixed manufacturing overhead, is attached to the product in manufacturing, in production, it is only expensed when it's sold. So that becomes part of cost of goods sold. In variable costing, it does not. It's all expensed. And so the difference between absorption and variable is the fixed manufacturing overhead that's still in inventory. So what we want to do, okay, so this is simply my variable costing right there. And then what I want to do is I want to go, okay, how many units stayed in inventory? And so I can look on my problem and I see in July that I produced 17,500 and I sold 15,000. So 2,500 units are sitting in inventory. Now I know that my fixed overhead per unit is $18. So if I take that 2,500 times 18, that gives me 37,500. Let me make sure I'm looking at this right. 2,500 and my fixed overhead is 18. Oh, knew that wasn't right because it wasn't going to reconcile. There we go, it's 18. I said it right, I just didn't type it right. Okay, and I know that my absorption was 10,000, so I'm looking pretty good here right now. And so if I reconcile the two, or sum them up, I get 10,000, which is exactly what was given to me in my problem under absorption costing. So I know I did this right. Okay, same thing here. We have 140,000. Now this one, I want you to think about what happened. You produced 17,500 and sold 15,000 in July. So you've got 2,500 sitting in ending inventory. In August, you produced 17,500 and you sold 20,000. So you basically got rid of all of your inventory. And so you have to really read this right here. You add or deduct, on this one we added, fixed manufacturing overhead, deferred in, and I need to add, or released from inventory. So we had some units released from inventory is basically what that means. And we're going to deduct those because they were released from inventory. It was 2,500 units released and still at the $18 per unit. And so when I add those together, I get my auto sum and I find out that my absorption net cost net income should have been 95,000, which it is, and so I have reconciled the two.